So, Jeff, the question is, okay, you got a 6% dividend on AT&T. It's easy to get suckered by a juicy yield, but maybe
100%.
AT&T is a buy.
Well, if you look over the last 3 years, Tyler, it is not a buy. It's been down over 30% on those 3 years. But I want to be a buyer here. But to your point, you have to understand where this fits in the portfolio. When I talk to all the sanctuary advisors, we have to understand this is part of a diversified approach inside of volatility. But if you look at AT&T, it's dipped back below its June lows. It had a recent scare that they weren't going to be able to collect some of their bills. If you think of Caddyshack, when Rodney Dangerfield was going to send Moose and Rocco out to collect from Judge Smells, similar situation here. But the CEO, John Stankey, is reassuring that there's going to be $20 billion of free cash flow to support that dividend in 2023. So I think it makes sense to be a buyer here. You just have to understand that they still are going to pay out 40% of their cash flow, but this has been a tough stock.
Mm-hmm. What are your thoughts, Jeff, on Simon Property Group, which also has a 6% dividend yield?
Well, Seema, think about a REIT in itself. This is the second largest REIT in the United States, so 6% yield is attractive. But if you look again over the last year, this has really had a haircut. Had a great year in 2021, and now it's had a significant pullback. When you see last year is up over 95%, I think you have to consider where does this fit in your portfolio. But the one thing that's positive, and maybe I'm a little bit early here because I do want to be a buyer of Simon's group as well. Where I'm a little bit early is that we're just seeing about a 200 basis point uptick. What does that mean? Well, last year, their capacity of their rental rates was about 91.9%. You're seeing it near 94%. So I think it's turning around. We're seeing people return to work, but this is one of the biggest players globally. They have new projects coming online over in Paris and Tokyo. So maybe we see a little bit of China open up, help this stock and attract some assets. But remember, this is a REIT that makes a ton of sense as one piece of the puzzle, and it's on a deep discount.
Boy, you got 94%. Remember 2 years ago, Seema, people were talking about the death of real estate, the death of stores and so forth. Here's one's 94% occupied globally. I think the next stock we want to look at is Pioneer Natural.
Pioneer Natural. So you're going to ask me, Tyler, did I not wear my helmet the last year of my football career? But nonetheless, I did, and I am booking profits here. So I know I put a sell on this, but look at this name. This name has had a sensational, just in the last month, Ty, you've seen Pioneer go up 30%. This is kind of like a REIT. It nearly pays out 80% of the cash flows. And to your point, you talked about, this is like the leading S&P 500 dividend. So we like energy, but I think at this moment in time, you have to book profits. I think you have to be considered that there's a buyback program here. In Q1, they bought back $250 million. They're committed to $4 billion. But after such a wonderful run, I think you have to sell this. You have to book profits and look for a lower entry. But again, remember where dividends fit into your portfolio. And you can't get lured by a dividend yield if the stock goes down. If you're getting 12% here and the yield and the stock goes down 30%, pretty sure that math is still losing, Ty.
Yeah, so here your call is, if you own it, look for opportunities to book profits. If you don't own it, look for a better price to get in. Right.
And we've owned Occidental, exactly. We've owned Occidental instead of this, but nonetheless, all the energy, the tactical model that I'm the portfolio manager of, we actually just booked some profits last week at energy. So we're not walking away from energy. We think demand is still going to be there. I don't see a recession, but nonetheless, pigs get fat, hogs get slaughtered. That's an old term we use in the pits in Chicago.
Quick thought on the market that we're seeing today. Our first guest from Albion said he expects a recession in 2023. Garden variety, nothing too dramatic, but that it's going to be hard for stocks to make headway against that prospect. What do you say?
I disagree, and I go back to where I cut my teeth in this market. It was the fixed income pitch. Look at the U.S. Treasury markets. They're not buying into the hawkishness that the equities are with the selling price you were seeing. So I think we're halfway through the last meeting and the September meeting for the Fed. So I think we have to take a big, deep breath and realize that we're going to continue to see volatility. We're going to see back and filling in the S&P 500. But the Fed, I believe they're going to do 50 basis points. I think they were very much like the chicken hawk that Jerome Powell is. He was talking the talk. I don't think they walk the walk, and I don't see a recession. I see a soft landing, Ty.
Interesting. Jeff Killburg, thanks very much. Have a great weekend, sir.
Thank you.
You too.
Shepard Smith here. Thanks for watching CNBC on YouTube.